Welcome to the Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Good afternoon, everyone. You're listening to The Real Estate Show. I'm your host, Terry Kilakos, chartered real estate and mortgage broker, as well as president and founder of Northeast Real Estate and Mortgage Agency. And today we're talking about income and what you need to know in order to qualify for a mortgage. We're also going to be taking a look at credit and how important it is, what affects it, and most important, how to improve it. So this is a question that comes up all the time, and are the switchboard lights up? There's a million and one texts that we get calls for it. No one talks about credit, and today we are going to be talking about it. Last week we talked about down payment and what were acceptable sources of it, and how to come up with those funds creatively if you don't necessarily have it right off the bat. If you didn't get a chance to listen to that show, you can always listen to it by going on our YouTube channel, which is newsonthego.ca, and I believe
also on Spotify.
Yeah, that's what I was going to say. Yeah. iTunes, Spotify, we're everywhere. I mean,
Spotify, SoundCloud,
yeah.
Wherever you turn, and the Real Estate Show is there.
That's right. And the voice you are hearing, joining me in studio, we have my beautiful co-host, Merav Marciano, chartered real estate and mortgage broker and vice president of Northeast, and my wife also. So, it's...
Thank you.
Sorry, all the ladies that are listening. I'm sorry.
Sorry, ladies. He's taken.
Feel free to reach out to us. The producer's rolling his eyes. Sorry, Marco. Feel free to reach out to us during this week at the office at 514-680-4674, or you could visit us online at northeastmortgages.ca. You can also visit our Facebook page, which is facebook.com/northeastmortgages. And be sure to subscribe to our YouTube channel, which is newsonthego.ca, which hopefully one of these days I'll get the opportunity to go in and change the title to something a little bit more practical.
Real estate-y.
For those of you that have seen my YouTube channel, if you go back to like the older videos, what you're going to actually see is you're going to see me walking around Montreal with a coffee cup and giving mortgage news on the go.
Yep.
That's why it's called newsonthego.ca. But it'll be changed eventually when I come around to it at some point. So let's kick off the show, Merav. I always like to give mortgage 101 lessons to my clients about my financing triangle and what it is that you need to know to qualify for a mortgage, which is why we do these little capsules once in a while. Last week we looked at creative ways to getting your down payment, and this week we're going to be looking at income and credit. And let's dive into it.
Yep. These are really important because it's the pillars of mortgages, right?
Exactly.
So again, Terry, what are the acceptable sources of income that a bank will look at?
So obviously there's the basic stuff, right? So if you're a salaried employee, obviously letter of employment, pay stub, that's the easiest way to...
Even if it's a brand new job, you have to be there for a year?
Okay, so if you're a salaried employee and you've just started a new job, you have to throw that little curveball in there for me, okay?
I know the answer, but I like to bug you.
So, it's a... as long as you're not on probation, you're okay. So you can literally start a brand new job. You could be there for a week, 2 weeks. If you're not on probation, you're good to go. No problem. However, we do live in Quebec, and most jobs, when you apply, you get a 3-month to 6-month probation period. And if you're on probation, your income doesn't count. So you have to be past your probation when you're applying for work.
Because technically you could be terminated at any point when you're on probation. I understand that logic.
Exactly.
Yeah.
So salaried employees, so salary counts. Rental revenue counts, not as much as people think, but it does count. Investment income counts. We have to have a couple of years of history for it, but we can use that. Self-employed income counts.
How does it work for the self-employed? That's a complicated one, no?
Well, why don't, you know what? Well, I'm going to kick it over to you. How does it work for self-employed?
For self-employed, you have to have been self-employed for 2 years in the same field, or your company has to have been around for at least 2 years.
Yeah.
And they take 2 years average usually.
Yeah.
Your average I want to say
your last
net.
2 years.
I want to say net, but it's not net. It's your gross minus expenses. Do we call that net? Because net for me is more after taxes, you know.
So this is...
it's line 150. That's how I know it.
Yeah. So this is a big problem. And I have a lot of clients that, you know, that are self-employed, and they call me up and they say, okay, I want to apply for a mortgage. I want to refi. I want to do whatever it is that they want to do. And when they call me for that, my first question to them is always, how much income did you declare last year? And they say 150,000 or whatever it is that they declare. And I say, okay, no. What shows up on your notice of assessment? 150,000. And then I get their notice of assessment and it's like 60, because to them, what they gave to their accountant was 150,000, and the accountant went in and wrote off everything under the sun. And then they end up with an income of $30,000, $40,000, $50,000.
I've even seen some zeros out there.
I've seen zeros. I've seen minus 1,000. You know, I've seen everything.
But that's unfortunately a lot of
accounting.
Yeah, I don't want to say that because we're going to get slammed by the accountants, but it is bad advice they're getting from somewhere. Just write off everything, pay no taxes, because at the end of the day, they're being penalized. They can't get mortgages. They can't get cars. They can't get anything like that.
Exactly. So it's important that you have to have a balance. And even, I mean, you have to think about this logically. I had a young lady call me recently, and she was self-employed, and she wanted to buy this house that was worth, I don't know, like $800,000. And she was declaring very little revenues. She was self-employed, declaring very little revenue, and she goes, look, you know, I can declare more next year. And I said to her, it doesn't work like that. The bank doesn't care what you're going to be doing in the future. They want to see what you've done in the past.
Yeah.
So you always have to be, when you're self-employed, you got to be thinking 10 steps ahead, always. And not only that, imagine she goes out and she buys this $800,000 home, and now all of a sudden she continues to declare $30,000, $40,000. The government's going to come to her at a certain point. They're going to say, excuse me, how are you able to afford to live in this $800,000 home and you're declaring $30,000 of revenue? It's
called a lifestyle audit. They do that.
Exactly.
I know that.
And you are, pardon the expression,
screwed.
Yeah,
yes.
Exactly.
To say it cleanly, yes, absolutely.
That wasn't very clean the way you said it.
It was more clean than what you were thinking.
Exactly. No, but it's true.
Yes.
It's really not good. And at the end of the day, you know, you have to have a little bit of foresight. You have to think in the future. If you know that you're going to be buying properties, if you own properties, you need to declare a certain amount of money. And this goes hand in hand also with what we talked about last week. Buy RSPs to offset the income. You know, declare your $60,000, $70,000, $80,000 that you need to use to qualify for the mortgage, and offset that income by putting money into your RSP, right? And then you could still use that RSP money for your down payment.
Yeah.
Right. So you got to be smart. And this is where, we come in, and we sit down with people and we help them analyze their real estate kind of needs from A to Z, including how to structure their incomes if they're self-employed. So it's setting up a long-term plan. So if they say, I want to buy in 2 years, you say, look, you're really not declaring enough for the next 2 years. Make sure to not write off all of your expenses, because it doesn't make sense the way you're doing it. It's great that you're paying zero in taxes, but you're never going to qualify for a mortgage with this kind of income declared, or at least you're never going to qualify with a low down payment. No, exactly. So I think that it's very important that we kind of make sure that incomes are structured properly, and the bank kind of looks at it and they say, yes, this makes sense, this is good, we're rock and roll, okay, we're ready to go on it. So salary, we said, is no problem as long as you're past your probation period.
Yep.
Now here's something interesting. I have actually seen people get kind of even sidetracked with salaries, and we're going to get into that after the traffic break. You're listening to The Real Estate Show on CJAD 800. Coming up, we're going to be looking at the new qualifying rate and how this can affect your buying power. Now we're off to the CJAD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking more about income, qualifications, and credit. If you haven't done so already, please take a moment to subscribe to our YouTube channel, which is newsonthego.ca. And if you want to reach us at the office, you can call us at 514-680-4674. So,
during the break, very interesting conversation there about salary. So, what did you want to...
Okay, let's... just because you're on salary, it doesn't mean, what I said earlier might have been a little bit misleading, okay? And I just want to clarify something. A salaried employee has to be someone that is full-time and permanent. It can't be someone that's on contract. If you're on contract, no problem. We need 2 years notice of assessment to approve that income. So that's a little kind of side thing.
Yes.
The other thing is if you're part-time, you can be part-time or on call, but we need, again, 2 years average to qualify that income.
Or if you have some sort of base plus commission, 2 years.
Exactly. So if we want to count just the base, which I do all the time, I love to, my main goal for every client that walks in the door is I want to simplify their life. So if I'm able to qualify your mortgage using just your base revenues, that's what I'm going to do. However, if I need to use your commissions or bonuses or anything like that, then at that point, what I'm going to do is I'm going to ask you for 2 years average to qualify that.
And just to be clear, notice of assessment is your taxes. After you file your taxes, it's
what you get back from the government.
That sheet you get back from the government, like sort of the summary of what you filed.
Exactly. And if you're listening to this anywhere else other than Quebec, it's one document, which is your CRA document, which is your Canada Revenue Agency document, your notice of assessment. In Quebec, because
we've got two governments.
We're a distinct society. So we would have to see the notice of assessment from Revenue Canada and the notice of assessment from Revenue Quebec.
Now, you mentioned qualifying rate, but before we jump into that, can I just ask, with respect to child tax benefit and child support, those are calculated, they're counted by a lot of the banks, right?
Yeah, so child support, okay, so money that you're, from a court order that you're receiving from a spouse.
From an ex-spouse.
From an ex-spouse is counted 100% provided there is a court order for it. Okay. If you were common law with someone and your
they can't just write you a check once a month.
They could, but it has to be quartered. There has to be a document that says that you are receiving this money.
Okay.
When we're talking about allocation familiale that you're getting from the government, most banks will accept it. Most banks won't accept it. We have a few banks that will accept it. And even that comes with certain conditions. The children have to be under the age of 12. So if you have a bunch of kids and, you have two of them that are over 12 and, two of them that are under 12, well, then the ones that are under 12, the income will be counted for them, but the ones above it won't be counted.
Because they want to know for the next 5 years of the term, you're getting this money.
Exactly. And I just want to go into a little bit of detail about the income side of the triangle, right? So when we're looking at the income side, last time we talked about equity, how there is a ratio that's involved with it, and that's the loan to value. Well, on the income side, there's a ratio as well, and it's called your GDS ratio and your TDS ratio. And your GDS ratio basically looks at all the debts that are specifically related to the property that you're buying, and it could not exceed 39% of your income. So if you're making $100,000 a year, for those of you that heard last week's show, I love $100,000 kind of round numbers because I could do my calculations easily in my head. So that means that no more than $39,000 a year can be used for your property and school taxes, your heating costs, your mortgage payments, and your condo fees if you have them. The TDS ratio, which is the other one, says that no more than 44% of your gross annual income can go to paying those debts, plus any car payments you have, any loans, any credit cards, lines of credit, student loans, anything like that. So as long as your ratios stay under 39-44, you're good to go.
And those are called your indebtment ratios. It's basically the government putting in place these numbers so that to basically protect you, to not be over indebted and,
Exactly.
Put a strain on the system at the end of the day. It's to protect us that these numbers are put in place.
So
let's talk qualifying rate. Sorry, because you mentioned it before the break, and I know that it went down. I'm curious, what did it go down to, and how does that affect us?
Okay, so again, the qualifying rate is part of the stress test. Okay, so once upon a time when you would apply for a mortgage, if you had a rate of 2.99%, for example, that was the rate that was used to qualify the mortgage, unless you were on a variable, in which case the bank would be using a higher rate, usually the 5-year fixed rate, to qualify it. Then the government stepped in, and the government said all mortgages have to be qualified at a benchmark rate. And the benchmark rate that's being used is the Bank of Canada rate. And currently, we're looking at a rate of 4.99.
4.94.
4.94?
4.94 a couple days ago.
Okay, so we're looking at a qualifying rate, 4.94, 4.99, somewhere in that vicinity. Which means that when we run the GDS TDS calculations and we calculate that mortgage payment, it's based not on the rate that you are receiving. So you could be getting 1% for a 5-year fixed. By the way,
doesn't exist.
Yeah, don't call me and tell me you said that I can get 1% for a 5-year fixed. I didn't say that.
But you just said that.
Yeah. Let's say you were getting that. You could be getting 0% interest, whatever. It doesn't matter, okay? The rate that's used to qualify the mortgage is the benchmark 5-year fixed rate of the Bank of Canada. Okay, so because you end up having that benchmark rate that's being used, that's what's called the stress test. And the government was actually looking at reducing the stress test, and they were supposed to do that April 6th, but we had this whole, craziness that happened with, COVID-19 and stuff, and it kind of threw a monkey wrench in everyone's kind of...
So obviously, your indebtment towards the mortgage looks bigger when you're doing those calculations. So that's why the stress test actually hurt a lot of people in that sense. And a lot of people from the mortgage industry were against the stress test because it was something that didn't make sense.
Yeah. And we lobbied the banks. There was petitions. There was all kinds of stuff that went out. And we begged the government to reconsider. And they didn't. And unfortunately, the majority of the MPs, the majority of the people in Parliament didn't even understand what it meant. And I've had MPs come into my office and, they came in to see how things are. And I said, well, sit down. Let's see if you qualify for a mortgage. And then you tell me if and unfortunately, this whole thing basically knocked about 20% of the population out of the running to being able to buy a property. It reduced people's buying power like crazy. The other thing that it ended up doing, and I've done many shows about this, and people know exactly where I stand, as far as it goes with the stress test. But unfortunately, what it ended up doing is it actually increased the value of certain homes. So, for example, homes that were selling in the $200,000 to $300,000 range, now all of a sudden that's the market. And that, based on the Quebec incomes, this is the sweet spot, $250,000 to $350,000, where people now all of a sudden are able to qualify for, right? So now all of a sudden there's bidding wars on these properties. People are going nuts to buy these properties. So you end up having these prices shooting up, not because... they're worth it.
There's so few and far between in that price range.
Exactly.
Before the stress test, you would have bought something at $400, and now you have to look at, $300 to $350. So it definitely it squeezes down the amount of houses available out there, and everybody's fighting for those same houses.
Exactly. And the other thing that unfortunately it's done is it's caused a lot of people in the price range of anywhere between $450 to $550 to stay put, to not move. Because they know that with a new stress test, they wouldn't qualify to buy something at a higher price. So now there's an even bigger lack of inventory in that price range, which drives prices up again. The scary thing was this week I was driving into the office, and I sensed like this disturbance in the force. And the disturbance was there was no for sale signs anywhere. Before, like, the streets are lined with for sale signs. Now, all of a sudden, because of COVID, because of everything, there's no for sale signs. So what's happening to prices? Prices are going up, and we have people going nuts. Coming up, we're going to be looking at credit and, if you have a good one, how you can improve it. And if you have a weak one, how you can improve it as well. Stay tuned. You're listening to The Real Estate Show on CJAD 800.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Thanks for joining us on The Real Estate Show. Today, we're looking at income and credit. And right now, we're going to be focusing 100% on credit. If you haven't done so already, please take a moment to subscribe to our YouTube channel, which is newsonthego.ca. As well, you can visit us online at northeastmortgages.ca, and you can call us at the office at 514-680-4674. And Merav is looking at me like I'm completely wired because I have like these very big eyes.
How many coffees did you have today?
A lot.
So credit. I feel like there's this big veil of secrecy.
There is a big veil of secrecy.
Around Equifax, TransUnion, and all these companies where it's like, shh, don't tell anyone how we calculate this.
Okay, so let's look at the different agencies, right? So there's the third part of our financing triangle, which is credit. And ideally, you should have a credit score of above 650. And the scoring system that's used to determine your credit score is the FICO scoring system or the Beacon score. So depending on if you're pulling a Equifax report, it'll be called a Beacon. If you're taking a TransUnion report, it'll be called a FICO score. And if you're taking an Experian one, I have no clue what it's called because I don't pull Experian reports, and no one does
more
anyways.
In the States. Yeah.
Exactly. So, so for me, what's important is your Beacon score on your Equifax report. Now, the important thing to remember is there is over 130 different types of scores that you can have. Right? So you can have, there's a different scoring system for when you're applying for a car. There's a different scoring system when you're getting insurance. There's a different scoring system when you're getting a mortgage. Every time someone looks at your score, it's a different metric that's used. If it's for mortgages, it'll be your Beacon.
I've even seen when I pull my own credit and then I go to the bank, it's a different number. It's not the exact same number.
Absolutely. So let's just look at that for a second. So when you're doing an inquiry on yourself, a lot of times what you're looking at is what's called an ERS score. That's a different score. It's a soft inquiry. It's a different score than what you would be getting if you were doing a hard check with a mortgage broker or with a banker, right? There's a lot of kind of credit reporting websites, if you will, where you can go and you can get free credit checks. And I want you guys to be smart about this. And hopefully there's no advertisers that are about to go on because I'm about to, quash something here. Think about it. You're a business person. You design a website that costs you, I don't know, millions upon millions of dollars to generate credit reports or credit scores for people.
For free, quote unquote.
For free.
Yes.
You spend millions of dollars on advertising to get people to come and use your platform to get free credit reports. Hello. Why? Does that make sense? Well, that reason why they do that, so the Borrowells and the Credit Karmas and stuff like that, is because they sell your information to third parties for marketing purposes, right? So marketing is king these days. So as long as you're okay with that, you can go and you can get your free credit reports and scores from there. But most of the time, you're actually able to go into your Equifax profile, and you can get up to twice a year a free credit report through Equifax's website directly. You can also do that through TransUnion. There's a little form that you fill out, you send it into them, and they send it to you back, and you could even get a score with it. I think you pay $10 or something like that. You get a free score. You get a score with that as well.
And it doesn't affect your credit score.
Credit score. You could check it about 1 million times. So Merav, let's take a look at what actually affects people's credit scores.
Okay, so we've seen it all. We've seen, I think at this point we've seen 15,000 files, almost 20,000. I don't remember the exact
16,000 and change.
Exactly. Yeah. So bankruptcy, consumer proposal, obviously those are the credit
killers.
Yes.
Yeah.
I didn't want to use a harsh word, but they're the credit killers. You're basically telling the world I had debts and I couldn't pay them. So now they're saying, okay, now why are we going to lend you?
Exactly.
And of course we all go through hard times in life, and it's not fair to be judged for our past mistakes, or not even mistakes, our past circumstances. We find ourselves in divorces and sicknesses and all kinds of things. But unfortunately, that house of cards has collapsed, and now you have to rebuild.
Exactly.
So that's the big one.
Yeah, and it does go away. And I've always said you can spend an entire lifetime building up your credit bureau, and you make one mistake, and it basically just the whole thing comes crashing down. And it's very important that you do everything that you possibly can to preserve your credit. The other thing that is really bad, and it's in line with consumer proposals and bankruptcies, is obviously collections. So if you don't pay your cell phone bill, for example, and they file a collection against you, well, guess what? Yet it shows up on your credit bureau. And I, for myself, I had, I think every cell phone company back in the day, when I was in my early 20s, had a hitman after me. It was really bad. When I met Merav, I had like a pay-as-you-go phone.
I remember that. I can't go to that one. Yeah. They don't like me. How about this company? No,
they don't
can't do that.
So Merav, when we met, almost 20 years ago, she got me my first like real cell phone. And I've had the phone number ever since, because I became responsible after I met her. So
thank you.
So obviously collections are not a good thing. You wanna be careful with that. Paying your bills late is also not a good thing. And being over a certain percentage of the utilization of your credit cards is also not a good thing. So a lot of times people think, well, I have a $10,000 limit on my card, I can use $10,000. Yes, you can. The bank will authorize it. They'll allow you to go there. But the minute you exceed about 65% utilization of your credit score gets dinged.
And what happens when you go over limit?
If you go over limit, I mean, it's literally suicide. It's 30 points instantly off any card that you've
even
gone
a dollar over limit.
You could be a penny over limit.
Yeah.
It will literally knock 30 points off of your file.
So it's really a report card of how responsible you are.
Yeah.
Whether it's due to any kind of circumstances or not, this is your report card.
Exactly.
You got a bad grade on this, and now you're going to be punished for it.
The good news is that when you are over limit, let's say your credit is bad because you're over limit on something. Well, in a case like that, it's very easily repairable, and it's just a matter of getting it under limit. And a lot of times when you get it under limit, within 30 days, you'll recoup those 30 points that you were...
That's good news.
It is good news.
Yeah.
But just make sure that you're always...
And I've seen you do that consulting.
Time and time again.
Yeah. You basically have a quick look at the credit bureau and you say, you know why we're not able to qualify right now? Because this. Let's do this again in a month or 2 months. And suddenly we see a huge hike in the credit score.
Yeah. And for me, I'm the type of mortgage broker that when I look at someone's, credit profile and they're coming in for a refinance, and when I see it, I identify a need for alternative financing, for example, because, they have a weak credit score or whatnot. I don't want to put anyone in alternative financing. I want to go with traditional lending sources. So because I want to go with traditional lending sources, you got to have the strongest possible credit. So I will help you, before I put you with alternative financing, I will help you build up your credit profile so we can go the traditional
And in
route.
some cases, we have no choice. It is a 6-month solution where you have to go alternative or private.
Exactly.
Till
it does
you
happen.
fix that problem, and then you can go towards the traditional route.
Exactly. It does happen, unfortunately, but it's rarer, we'll say. Okay, rarer, if that's even a word. Now, the other thing that impacts you is inquiries. So the more inquiries that you have on your file, the more you're going to get impacted by that. So your first inquiry that you do on your credit profile is worth 1 point. Second one is 1 point. Third one is 3 points. Fourth one is 3 points. Fifth one is 5 points. And every subsequent one is 5 points after that.
And that starts hurting.
And you get a penalty of an additional 25 points retroactive. Oof. And that stays on your profile for 12 months. So it's important, the amount of inquiries, and we're going to talk a little bit about that in a little bit. Coming up, we're going to be looking a little bit deeper into your credit. If you don't have good credit, how to improve it. If you have great credit, how to make it even stronger. You're listening to The Real Estate Show on CJAD 800. Now we're off to the CJAD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Thanks for tuning in. You're listening to The Real Estate Show on CJAD 800. Let's get back to talking about credit and how to improve it. Merav, before the traffic break, we went off and we were talking a little bit about inquiries.
Yeah, and it dings you quite a bit when you do a lot of inquiries. So if you go out there shopping for a home and you're going from bank to bank, that hurts.
Yeah, so there's a rule that basically says that within a short period of time, within a certain window, if you make inquiries that are all related to the same thing, it'll all count as one.
That's what they say, but I've seen.
Exactly. I know.
I've seen 5 inquiries back to back.
So let me tell you where the problem comes in. When you come to see a mortgage broker, you see the mortgage broker will pull your credit, and that credit bureau is good for X amount of time, and we can take it and we could send it to 20 different banks, and nobody's going to check your credit other than us. All the banks will go based on what we have given them. Okay?
One credit bureau,
one credit check, we're good to go. If the bank happens to see an anomaly or they see something weird on that credit profile, what they're going to do is they might pull the TransUnion report. So if we've given them an Equifax, they might pull a TransUnion. If we've given them a TransUnion report, they might pull an Equifax report, okay? But for the most part, they will go based on what we have given them. When you go into a bank individually, so you go to Bank ABC. Bank ABC is going to check your credit. Then you go to Bank XYZ. Bank XYZ is going to check your credit. Every bank that you visit, they're going to do a credit check on you. This is where it gets bad. And this is where people need to really, a light bulb needs to go off with what I'm about to say here. You walk into a bank, you say to the teller, I'm looking to get a mortgage. Teller says to you, well, why don't you go meet with Mr. Smith over here, and Mr. Smith will pre-qualify you. You go and you meet with Mr. Smith or Mrs. Smith, whoever, and they're going to run a credit. You're going to check your credit. When they check your credit, they are not part of the mortgage team for the most part. They are not part of the credit center for the mortgages, which means that when they approve you, when they check your credit, they have to send it afterwards to the mortgage center. When they send it to the mortgage center needs to pull the right score for you. So one bank, when you go and you visit them, they're going to check you 2, 3, I've even seen 4 times, all within a week. And it's all different people, different departments of the bank.
Different types of scores,
which means now that you have had 4 inquiries for one bank. And if you don't trust what I'm telling you, I have countless credit bureaus that I use as demos, where I've eliminated clients' names and social security numbers and dates of birth and all that stuff, and I've scrubbed all that data off, and you can see clearly one bank, 3, 4 inquiries, and then that person has gone to another bank and you got 3, 4 inquiries, and then when they come to us, we pull their score, and their score is super low, and they say, I don't understand. I had gone to the bank 3 weeks ago, and the bank told me that my credit score was 750, and now you're telling me my credit score is 690. It's because of all the inquiries. Mm-hmm. And remember what we said before traffic. The first inquiry that you do is 1 point. The second one that you do is 1 point. The third one that you do is 3 points. The fourth one is 3 points. The fifth one is 5 points, plus an additional 25 points penalty.
Because now you just look like a credit seeker.
Exactly.
Now you look again irresponsible.
Yeah.
This is a report card of how responsible you are with credit. That's what it is. Is it fair? Is it not fair? This is what it is. And we have to accept that. It's a report card where different financial institutions, lending institutions, utility companies, etc., they all report back to say, hey, this guy is responsible. He's not responsible. And that gives other people an idea of whether or not they should lend to you. And are you going to be responsible with that credit? It's a privilege. It's not something that you deserve.
And unfortunately, a lot of times people think that it's, their God-given right to have credit. Unfortunately, it's not. You are being lent money by someone. And it's important to remember that fact. Okay.
So now going back to going to a broker, so what you're saying is that with a broker, it's only one
credit check. That's it. The credit bureaus that we pull are usually good for 30 days. After 30 days, they expire. So if you haven't found a property within the 30-day window, we tend to have to check it again. So I'm the type of broker where if you have the opportunity, what I'm going to do is I'm going to ask you to go and pull your own credit bureau. And I'm less concerned about seeing what your score is, because as a mortgage broker, after seeing as many files as I've seen, and even not just me, I mean, anyone that works in our company, we're able to ascertain approximately what your credit score is. So what we're going to ask you to do in many cases is to just, especially if you're coming in for a pre-approval, if you're coming in for a refinance, we're processing the file right away. But if you're coming in for a pre-approval, we're going to ask you to do a credit check on yourself. Pull your credit bureau, bring it into us. Let me take a look and see what's on there. If I see something weird in there, I'm going to tell you what you need to do to fix it before I actually pull your credit bureau. Right? If everything is hunky-dory and great, I will issue a pre-approval based on what you have. And then later on, when you find the property, we'll do an official credit check on you.
Yeah, and in some cases, they already have some houses in mind, so we do pull their credit right away. It all depends on the timing, of course.
100%. Yeah.
Yes. Yeah, and again, that's the benefit of using a broker versus going to the bank. You just have to have one credit inquiry.
You Wesky Wabbit.
One credit inquiry.
Some important things to kind of remember also when you're about to apply for a mortgage. If you know you're over limit on something, pay it down.
Yeah.
So
that's going to improve. So speaking of improve, let's talk about ways to improve.
Okay. So if you're over limit on stuff, let's get it down. Okay. Get it under limit. Put some distance between the limit and the balance. Okay. So
what kind? How much?
You have to look and see how much interest is being charged on a monthly basis. Okay. And just make sure that you have that amount available plus a little bit more. So that way, when there's an interest charge that's put onto your credit card, it doesn't send you over limit again. Okay. So that would be the first thing. And just make sure that you're under limit and you have enough distance so that when there's the charge that goes on, it doesn't put you over. I usually tell people on average for, let's say a $10,000 card, just make sure you have a good $500 clearance there, because that'll give you enough wiggle room.
But what would be the percentage that would be ideal?
65%. Do not exceed 65% utilization. Now, a lot of people think that, I don't, that have a $10,000 card. I don't use it. I'm about to apply for a mortgage. I'm carrying a balance of $3,000 on my credit card. So I want to look good for the bank. So what I'm going to do is I'm going to reduce my credit limit. I'm going to reduce it from $10,000 to $5,000. What did you just do? You just increased
the percentage of utilization. And now you look irresponsible again.
Even though you are super responsible.
Yes.
Right? The other thing that I see people doing all the time is I see them canceling credit cards.
Yeah.
Right? People will go off, they'll cancel credit cards, but they'll cancel the wrong ones. You don't cancel the cards that have history to them. The ones that you've had forever, keep them around, because those are the ones that are reporting positively. And they have a lot of weight. Credit cards that come from banks, RBC, Scotiabank, Amex, which is not a bank per se, but these
TD, CIBC, all of the big ones.
Yeah, CIBC, oddly enough, less. Not to say anything bad about CIBC, they're a great lender, but it is less. Has less weight on their credit bureau. RBC has huge weight. Amex is massive amounts of weight that it has on your credit bureau. So if you have these cards, keep them and make sure that they're taken care of. The other thing that you want to make sure that you're taking care of constantly, and you're not your cell phone. It's something that's overlooked by most people. People forget to pay their cell phones all the time. They pay them late. Guess what? Your cell phone appears on your credit bureau. And it has less of an impact on your credit score, but it's still there. And banks still see it. And if you have late payments on it, they're going to question it. They're going to say, why are you late on like this $30 payment?
Yeah, and what's silly is that even if it's a $30 payment that you're contesting and you're like, absolutely not, I am not paying this $30. If it goes into collection, you're going to take a nosedive on that credit bureau.
Yeah, absolutely. Now, here's something you just hit the nail on the head. We have people that are super responsible. They're like, I've paid down my credit card. I've paid it all off. I have, I don't have anything owing on it anymore. But what they don't realize is that the following month, there's going to be a little bit of an adjustment that's going to go on that account. And
that daily interest.
Yeah, that daily interest.
Yes.
And that daily interest, when it goes on, it'll show up on the credit bureau. And if you miss it, then you end up having an R2, an R3, and so on and so forth. Merav, we've run out of real estate. Guys, if you want to get a hold of us, you can reach us at the office at 514-680-4674. As well, you can visit us online at northeastmortgages.ca. Till next week, everyone, have a blessed week.